Lesson 3, Spot and Futures. There are two ways to buy Bitcoin or other altcoins. They are completely different. Okay, so spot, this is the real thing. Spot Bitcoin is referring to real Bitcoins. You own it. You can withdraw it. It's yours. And with futures, you are buying a contract about the thing, not the thing itself. So one Bitcoin futures contract is not a real Bitcoin. You are not buying the asset itself. What you are buying and selling is a contract which is based on the price of the asset. And the main use of futures is to speculate and or to hedge. And you also can't withdraw it off the exchange. To help understand futures contracts a little bit better, which are used for hedging and speculating, as I said on the previous slide, let's go back in time to 1950. Pretend that you are a cow farmer. You have 100 cows ready to sell at $1,000 per one cow to a meat packing company in 6 months from now. But you have a problem. What if the price of cows dropped by 90% in the next 6 months? Instead of making $100,000, you will only make $10,000. Sad face. But here's the solution. You can short cow futures and close the position in 6 months from now. So when it's time to sell to the meat company, you'll only get $10,000 from the company, because 100 cows times $100 is $10,000. But your short position would have earned $90,000 because it dropped 90%. So, and you're trading with a $100,000 position. So 90% multiplied by 100K is $90,000. That's what the profit on your short position would be. So your total revenue would be $100,000 because you've got the 10,000 from the company and you got the 9,000 from the short position. So total is $100,000. So that short position, it saved you a lot. And if the price of cows goes up, so the opposite situation, the profit is still going to be exactly the same. So when it's time to sell to the meat company, you will get $150,000 from the company because 100 cows times 1,500 is 150K. But your short position would have actually lost $50,000 because we have 50% of 100,000 is just 50,000. So your total revenue, again, is going to be $100,000 because it's just the 150 minus the 50, right? So your short position, it protects you from the downside, but it also won't let you profit from any upside. So your risk to the price of cows is now hedged. So if the price goes up, down, or sideways, your revenue for your cow business is locked in and unaffected. Using futures contracts to protect yourself from price risk is called hedging. Now let's talk about speculation. Pretend there is a trader in Chicago who has never seen a cow in his entire life. I think beef prices are going to go up, so I'm going to go buy some cow futures contracts at $1,000 a cow and sell it later for a profit. So what he's doing is he's getting long on cow futures because longs are betting on price to go up. So this trader doesn't actually want any cows. He doesn't even care about cows. Well, I'm sure if he met a cow, maybe that might change, but for this example, let's just pretend he doesn't care about cows. He just wants to profit from the price movement of cows. So here's a quick summary. So with spot, you buy the thing, likely because you want to actually use the thing. And if you want to profit from the thing, it's going to have to go up in price. But with futures, you're betting on the prices of things. You don't actually own the thing that you are trading. And if you want to profit from the thing, you can profit from price going up and down. Okay, so here's why I trade futures, not spot. So for most financial products, at least in crypto, there are more people who want to speculate on price rather than actually use the product. So this causes the average trade volumes to be bigger and the order books to be thicker in futures compared to spot. So this naturally leads to futures having cheaper fees and having lower slippage costs. Futures also allow traders to use leverage to open larger sized trades relative to whatever is deposited on their crypto exchange. And also, Futures allows traders to be a lot more efficient with their capital, thanks to leverage. So here's what I do with spot. So whenever I want to add real Bitcoin to my long-term portfolio, I'm going to buy some spot. I will then withdraw it from the exchange and into my own wallets, because not your keys, not your coins, right? So basically, I use futures for my short-term bets, and I use spot for my long-term holdings. That's it. So I keep it really simple. In the next clip, I'm going to go on BitUnix, and we're going to quickly talk about spot and futures, funding rates, and mark and last price. And by the way, if you're serious about improving as a trader, I'd like to invite you into my free Telegram. Here's what you're going to get inside. You're going to get a 100-page guide on how I trade breakouts. You're also going to get a 214-page guide on how I trade reversals. And by the way, these two guides, I go really, really in depth with the strategies, with the theory, with the logic, and also I include like total combined within these two guides. There's more than 75 trade screenshots for you to study, like through just continuous repetition, and it's going to help you train that pattern recognition of seeing the exact same thing happen over and over again. Also, you're going to get a custom trading journal that I built, which makes it really easy for you to track your trades, but also to review your trades. Like literally in the journal, there's a tab called educational resources. And in there, I have a template for reviewing trade screenshots and guide to show you the process for how to actually review your trade screenshots to improve your performance over time. And also a whole bunch of other stuff as well that I give out for free in my Telegram. So if that sounds interesting, click the link in the description to join.